Welcome to the True P&L Deep Dive. Before we start, a quick disclaimer. This analysis is provided for educational and informational purposes only and reflects my personal views. Adjusted data refers to outputs from my proprietary analytical models and may differ from officially audited financial statements.
And we also need to get this out of the way.
Right. Also, full disclosure, the creator does hold a financial interest in Sampath Bank PLC.
All right, legal housekeeping is done. Let's get to work.
Yeah, it is. It's pretty late. The market is closed, and we are sitting here at the desk at Ceylon Premier Analytics with a very fresh stack of paper in front of us.
The Sampath Bank FY2025 audited financial statements. Hot off the presses.
Exactly. And, normally people just gloss over the headlines when these drop. They see a big, bold number, maybe a percentage sign with a nice green arrow pointing up, and they just move on. But that is not what we do here.
Absolutely not. We are not here to read the annual report to you. I mean, you can do that yourself if you want to fall asleep.
Right.
We are here to strip out the noise, to ignore the PR spin, and really try to find what we call the true P&L. We need to know if the money they are claiming is real or if it's just, accounting gymnastics.
Yeah, we're looking for the story the numbers are whispering, not the one the marketing department is shouting.
Exactly.
So let's set the scene for you. Sampath released their financials this evening, and the headline number, the one that's going to be plastered across every business newspaper tomorrow morning, is this. Profit attributable to equity holders is 32.57 billion rupees.
32.57 billion.
Yep, and that is up 13.5% year over year.
Double-digit growth. I mean, on the surface, that looks fantastic.
Yeah.
In any normal year, you take a 13.5% bottom line bump and you go home happy.
It does look great. But here's the analyst's question that has been nagging me since I opened this file about an hour ago. We're in an environment right now where interest rates have dropped significantly compared to the crisis years.
Very significantly.
Right. And the economy is stabilizing, sure, but it's not exactly booming yet. It's very much in recovery mode. So in that specific context, how do you grow profit by double digits?
That's the anomaly.
Is this real operational alpha? Like, did they actually beat the market through sheer skill? Or is this just accounting adjustments painting a really pretty picture?
That is the multi-billion rupee question. And to answer it, you have to look past that 32 billion figure. You have to look at the engine of the bank. And when I looked at the engine, the core lending business, I noticed something disturbing immediately.
You're talking about the anomaly in the net interest income.
The elephant in the P&L, if you will. Let's look at the NII. For those of you listening who aren't glued to bank balance sheets all day, NII is the difference between the interest a bank earns on its loans and the interest it pays out on your deposits.
It's the bread and butter.
It is. It is the core manufacturing output of a bank.
Yeah.
If you're a bakery, this is the profit you make on the actual bread, not the money you found in the couch cushions out front.
And for Sampath Bank in FY 2025, that NII number was 83.57 billion rupees.
Which represents a drop. It actually declined by 1.3%.
Think about that for a second. Let's really let that sink in. The headline profit is up 13.5%, but the actual money made from lending the core business, the reason the building physically exists, is down 1.3%. That is a massive divergence.
It's a huge divergence. It suggests that the primary revenue driver is stalling out. And it gets much worse if you look at the margins. The net interest margin, or NI, just collapsed.
Yeah, in 2024, they were sitting pretty at, 4.90%?
Correct, 4.90. And in 2025, it fell 79 basis points to 4.11%.
For a bank the size of Sampath, a 79 basis point drop that's hundreds of millions, if not billions of rupees in lost potential revenue. That is a very serious squeeze.
Exactly. The engine slowed down. The car is moving faster because the profit is up, but the engine is revving lower. So the immediate question for any serious analyst looking at this is, if the core engine shrank, where did that 13.5% profit growth actually come from?
Right. If the bakery is selling bread at a lower margin, how is the baker driving a new Ferrari?
Precisely.
Well, I think I found the culprit. Or the savior, depending on how you look at it. It's right there in the impairment line.
Ah, yes. The magic number. Impairment.
Well, let's unpack this for a second.
Right.
In banking, you have to set aside money for loans that might go bad. That's your impairment charge. Usually this is a massive expense line on the P&L. It eats directly into profits. It's just the cost of doing business in a risky world.
Correct. In 2024, Sampath took a huge charge because the economy was shaky, everyone was scared, default risks were high. But look at what they did in 2025.
In 2025, they didn't just take a smaller charge. They recorded a net impairment reversal of 0.6 billion rupees.
This is so crucial to understand. They didn't just stop putting money into the bad loan jar. They actually reached into the jar, took money out, and put it back into the income statement.
That is a massive swing. It literally transforms an expense line into an income line.
Right. And effectively, a significant portion of that headline profit growth isn't from making due money from customers on interest spreads. It's from accounting reversals on past provisions.
So we need to be fair here. Is this justified? We can sit here and be cynical all night, but we also have to look at the facts.
The bank argues that with the reinstatement of the paired execution law and generally better recovery processes, they're collecting on loans they previously thought were completely dead.
And if the economy is improving, you should reverse provisions. That is what the accounting standards say you literally must do.
That's the bullish argument. And paired execution is a huge deal. For those who don't know, it gives banks the power to sell collateral without going through a grueling 10-year court battle. So logically, they should be recovering more cash.
Exactly, but here is the skeptical argument that I keep coming back to. Is this sustainable? You can't keep reversing provisions forever.
You can't. Eventually, the jar is completely empty. You can only reverse a specific provision once.
Precisely. So it boosts profit on paper for this year, but it doesn't reflect the ongoing run rate of the business.
Yeah.
It masks the fact that the core lending margins are under severe pressure. If I'm an investor looking at this for a long-term hold, I'm asking myself, once these reversals run out in 2026 or 2027, what fills the gap?
That is the strategic problem. And honestly, it seems the bank anticipated that exact question. Because while the margins were dropping, they made a very aggressive strategic pivot.
They realized they couldn't rely on high prices anymore, high interest rates are gone, so they switched to a volume game.
The volume versus price strategy. It's classic economics 101. If you can't sell your burgers for 1,000 rupees anymore because the market price dropped to 800, you have to sell 28% more burgers just to keep the lights on.
And that is exactly what they did here. The data is staggering. The gross loan book just exploded. It's up 28.2% to 1.29 trillion rupees.
That is incredibly aggressive. In a stabilizing economy, growing your loan book by nearly 30% is a bold move. Most mature banks are thrilled with high single-digit growth. This is practically startup-level scaling.
It signals a massive appetite for risk. They are not sitting on their hands waiting for customers to walk in. They are going out there and hunting for borrowers.
Let's dive deeply into that loan book because the devil is always in the details. Where is this money actually going? They didn't just spray and pray. They seem to have targeted very specific sectors.
They pivoted out of government securities. That's the first big move.
Right. During the crisis, banks loved government securities. They were yielding 20, 25, sometimes 30%. It was lazy banking.
You lend to the government, you take technically zero sovereign default risk on local currency, and you make huge margins. It was a license to print money.
But yields on government securities have completely crashed. The party is officially over.
Exactly. So Sampath took that money and poured it directly into the private sector. If you look at the LKR portfolio, the local currency engine, it totals 1.049 trillion rupees. But look at the breakdown.
Import loans. This stood out to me instantly. Import loans are up 78.3%. They reach 164.4 billion rupees.
That is a massive macroeconomic signal. A 78% increase in import loans tells us that trade is fully back.
The ports are busy. Companies are bringing in raw materials. They're bringing in finished goods. The working capital cycle of the entire country has restarted, and Sampath captured that wave perfectly.
And what does that tell us about the risk profile? Import loans are usually very short-term, right?
Yes, they are self-liquidating. You lend money to a merchant to bring in a container of widgets. The merchant sells those widgets and pays you back in maybe 90 days. It's high-velocity money.
It suggests the bank is betting on the flow of goods, not necessarily taking a punt on 10-year infrastructure project loans.
Exactly. And then there is leasing. It doubled, up 100% to 58.2 billion rupees.
This is smart. Leasing is asset-backed. If the borrower defaults, you just go take the truck, you take the machinery. It's significantly safer than an unsecured personal loan.
Aggressively pushing into asset-backed finance tells me they are definitely chasing yield, but they're trying to keep a collar on the overall risk. They want the interest income, but they want the keys to the vehicle too.
And pawning and gold loans are up to 102.4 billion rupees. That's the ultimate safe haven asset.
It's the best liquidity tool for the average Sri Lankan. Gold loans are high yield and fully secured. It's a fantastic business line if you manage the gold price risk properly. It's basically a fortress on the balance sheet. Even if the customer defaults, you literally have the gold sitting in your vault.
So, putting this all together, they saw margins collapsing on government debt. They realized NII was going to take a nasty hit. So they deliberately decided to flood the private sector with credit, specifically trade finance and secured lending, to make up the difference in sheer volume.
Correct. They protected the bottom line by taking on more risk. That's the fundamental trade-off. They replaced risk-free government income with risk-bearing private sector income. That completely explains how they survived the margin compression without profits imploding.
But there is another hero in this P&L, isn't there? We have to talk about the fee income.
The unsung hero of banking. Fee and commission income is up 22.9% to 22.37 billion rupees.
This is what we analysts call capital light income, right?
Exactly. If I lend you money, I have to set aside regulatory capital. It costs me balance sheet space. But if I just charge you a fee for a credit card transaction or a trade transfer or some digital banking service, that doesn't consume capital.
It's pure return on equity.
It's the best kind of money a bank can possibly make.
And a 23% jump there suggests that the economic activity we talked about isn't just a mirage. People are actually transacting. They are swiping cards at the supermarket. They are paying for trade documents.
It perfectly validates the import loan growth. If import loans are up, trade fees should be up. And they are. It shows absolute internal consistency in the report. This isn't just one department going rogue. The whole machine is revving up together.
However, we do need to talk about efficiency. Because typically when margins are tight and you are fighting for profitability, you want to cut costs. You want to run as lean as possible. But looking at the cost-to-income ratio, or CIR, it actually worsened.
It did. It went up to 42.71% from roughly 41.0%.
For a bank that is supposedly trying to protect profits, spending more money seems totally counterintuitive. Why let expenses creep up when your core margins are down?
It depends entirely on what they spent that money on. The management report explicitly says strategic investments in technology.
Is that just corporate speak for we hired too many middle managers or we bought really fancy furniture for the head office?
Normally, I would be highly cynical about that. But given the 22% growth in fee income, which is largely driven by digital channels, cards, and transaction banking, I'm actually inclined to believe this is muscle building, not fat.
You have to spend on the tech stack to capture those digital transaction fees.
Precisely. If they cut costs to the absolute bone, they might have missed out entirely on that 23% fee growth. So I'll give them a pass on the CIR deterioration, provided the fee income keeps growing at this pace. They are clearly building the rails for the future.
Okay, so we have the operational health check done. Margins are down, volume is way up, fees are up, costs are slightly up. But we need to sanitize this P&L further. We talked about impairment. Are there any other massive one-offs distorting the picture?
Yes, the exchange gain. We had to strip out the noise to find the true P&L. In 2025, Sampath recorded a 5.3 billion rupee exchange gain.
That's due to the LKR depreciation, right? The rupee moved to around 16.63 per USD implied depreciation against their net open position.
Correct. When the rupee weakens, their dollar assets are suddenly worth more in rupee terms. 5.3 billion is a very significant chunk of that 32 billion total profit.
And it's not operational. You can't bank on the currency falling every single year to make your payroll. It's basically luck, or at least just static macro positioning.
And we have to compare this to the baseline in 2024.
Right. 2024 was suppressed. Remember the Sri Lanka International Sovereign Bond restructuring, the SLISB hit?
How could I forget? Sampath took a massive one-off hit of 8.37 billion rupees in 2024 because of the haircuts on those sovereign bonds.
So 2024 profit was artificially low because of the bond loss, and 2025 profit is artificially high because of the exchange gain and the impairment reversal.
Exactly. This is why the headline 13.5% growth is deeply misleading. If you normalize for these wild swings, if you strip out the bond loss in 24 and you strip out the 4x gain and impairment reversal in 25, the core earnings growth is actually much flatter.
The business is healthy, yes, but it's not exploding in operational profitability the way the headline figure suggests.
The true P&L relies incredibly heavily on that 28% loan volume growth we just discussed.
This brings us to the ultimate test. We can argue about accounting adjustments, impairment policies, and exchange rates all night long, but there is one thing on a financial statement that absolutely does not lie.
Cash. Accounting profit is an opinion, but cash is a fact.
We need to run the adjusted operating cash flow model. For you listeners taking notes, this is the part that really matters. This is where we see if the bank is actually solvent in a practical day-to-day sense. We took the numbers straight from the source documents to see if the bank is actually generating liquid cash.
Let's walk through the math. We start with operating profit before working capital changes. This is the raw cash generation before they lend it out to new customers or pay it out to deposits. That number is roughly 62.4 billion rupees.
Okay, 62.4 billion, that's the gross intake. Then we obviously have to pay the tax man.
Right. Income tax paid was a hefty outflow of about 14.8 billion rupees.
And we have to pay for the physical branches and leases.
Lease liabilities paid were roughly 1.2 billion rupees.
So 62.4 billion minus 14.8 billion minus 1.2 billion. What is the final result from the adjusted model?
The adjusted net operating cash flow is 46.30 billion rupees.
46.30 billion. Now let's compare that back to the headline net profit we started the show with. The reported profit was 32.57 billion.
This is the absolute aha moment of the deep dive. The real cash flow is significantly higher than the reported profit.
We calculate a metric at the desk called the cash conversion ratio, or CCR. It's simply cash flow divided by profit.
And for Sampath Bank in FY2025, the CCR is 1.42x.
1.42 times. Explain to the listeners why that is so incredibly significant.
Usually in companies with very aggressive accounting, you see profit high and cash flow very low. That means they're booking sales they haven't actually collected yet. It's a massive warning sign of an impending liquidity crunch. Here, it's the exact opposite.
For every 1 rupee of profit they claimed in the annual report, they actually generated 1.42 rupees of cold, hard cash.
It is the most bullish signal in the entire report, period. It tells me that the impairment reversal we were so worried about earlier, it's not fake. The cash backing it is real. They aren't just accruing interest income, they're actually collecting it from borrowers. There's absolutely no accrual dependence here.
So despite the nasty margin compression, despite the heavy reliance on volume, the machine itself is just spitting out cash.
Correct. They have a cash machine that is working overtime. This totally validates the quality of earnings. Even if I strip out the Forex gains, the underlying cash generation is incredibly robust. It's like checking the bakery's cash register and finding it overflowing with bills, even if the accountant's ledger looks a bit messy.
That sounds absolutely great for the P&L, but a bank is only ever as good as its balance sheet. You can show amazing profit for 1 year by making terrible loans that blow up 3 years later.
The classic time bomb effect. We've seen it 100 times in emerging markets.
Exactly. We already said they grew loans by 28%. In banking, rapid growth is usually a giant red flag for future bad loans. Did their asset quality suffer this year?
You would certainly expect it to, but looking at the data, the stage 3 ratio, that's the ratio of impaired or bad loans to total loans, it actually dropped. It went from 4.69% down to 3.31%.
Hold on. They lent 28% more money, and their bad loan percentage actually went down. That sounds almost too good to be true. How do you lend to vastly more people and get better at collecting?
Skepticism is highly warranted here. Part of this is simply the denominator effect.
Walk us through that math.
It's simple division. The stage 3 ratio is bad loans divided by total loans. If you dramatically increase the total loans, the denominator, by 28%, even if the absolute amount of bad loans stays exactly the same, the percentage ratio artificially drops. So some of this improvement is just cosmetic because the overall book got so much bigger, it just dilutes the appearance of the problem.
But surely not all of it is cosmetic.
No, not all. Remember the strategy shift we discussed? They aggressively moved into secured lending, gold loans, and leasing. These are segments with historically much lower default rates, or at least much higher recovery rates, when defaults happen. By shifting the overall mix towards secured assets, they genuinely improve the underlying quality profile of the book. Plus, the economic recovery helps. People are earning real wages again, so they are paying down their old loans.
So it's a mix of math magic and actual strategic improvement.
I think that's a very fair assessment. They diluted the bad loans with a massive flood of better secured loans.
Now let's talk about the actual cost of this growth. You can't just grow the loan book by 250 billion rupees without using up capital.
This is the red flag of the report. This is where the rubber finally meets the road. capital adequacy.
The total capital ratio, or CR?
It dropped. It fell from 19.38% to 17.65%.
That is a very steep drop for 1 year.
It is. It's the steep price of admission for that 28% volume growth. When you lend to the private sector, the central bank regulator assigns a risk weight to those assets. A loan to a trading company consumes vastly more capital than a loan to the government. So as they swapped those safe government securities for private loans, their risk-weighted assets, or RWA, skyrocketed.
They are burning through their capital to fuel this growth.
Exactly. Now, 17.65% is still well above the regulatory minimum of 13.5%. They aren't in any immediate trouble. They aren't going to fail tomorrow morning.
But they can't do this forever.
No, you absolutely cannot grow at 28% every single year and burn capital at this rate. You will hit the regulatory floor incredibly fast.
And I think the board knows this. I saw a specific note in the report about a new debenture issue.
Yes, they have already officially approved an issuance of up to 20 billion rupees in Tier 2 debentures.
Refilling the tank.
They have to. If they want to keep this massive growth engine running into 2026, they desperately need more capital. That debenture issue is not optional. It's strictly necessary for their current strategy. They are refueling mid-race.
What about liquidity? Because capital is one thing, but if you don't have the cash to lend, you're stuck. Can they actually keep lending?
Oh, they are completely swimming in liquidity. The liquidity coverage ratio, the LCR, is nearly 240%, 239.79% to be exact.
The regulatory minimum is usually 100%, so they have 2.4 times the required liquid assets.
And look at their loan-to-deposit ratio, the LDR. It is only 77.82%. That means for every 100 rupees of customer deposits they hold, they have only lent out 77 rupees.
That completely explains the aggression we saw. They have a massive cash hoard. They are sitting on billions in deposits that they are actively paying interest on. They literally need to lend this money out to generate returns and stop bleeding interest expense.
Precisely. A bank with an LDR of 77% is fundamentally an inefficient bank unless it starts lending rapidly. The pressure from the executive team is entirely on the credit officers to push that money out the door. That fully confirms why we saw that 28% volume growth. They had no choice. They had to deploy the liquidity to survive the dropping rates.
Let's shift gears to the shareholders. We definitely have listeners who hold Sampath stock strictly for the dividend yield. What's the verdict there?
The declared payout is 10 rupees and 30 cents per share,
which translates to a total cash outflow of about 10.96 billion rupees. The big question is it safe?
We go right back to our adjusted cash flow model. The total dividend is only 23.7% of the adjusted operating cash flow of 46.3 billion.
That is highly sustainable.
Highly sustainable.
Yeah.
It's rock solid. They are comfortably funding this dividend from recurring cash flow, not from issuing new debt or selling off assets. They are paying you from the real profit of the ongoing business, not from selling the furniture.
So let's try to pull this entire deep dive together. We started with a fundamental question. Is this double-digit aggressive growth? Or is it an accounting mirage?
And the answer is complex, as it always is in banking. The headline profit is undoubtedly aided by accounting adjustments. The Forex gain and the impairment reversal are doing heavy lifting. Without those specific items, the profit growth would look much, much more modest. So in that very strict sense, there is a bit of a mirage on the surface level. But when you dig into the cash flow, the mirage completely dissipates. The bank is generating massive amounts of real, tangible liquidity. The cash conversion ratio of 1.42 proves beyond a doubt that the underlying business is generating incredible cash. The strategic pivot from government securities to private lending was timed perfectly to catch the economic upswing.
So the accounting is messy, but the core business is remarkably strong.
That's a great way to put it. The strategy was incredibly bold. They bet big on this Sri Lankan economic recovery by expanding the loan book by 28%.
Do you have a final provocative thought for the listener before we wrap up?
I do. If the macroeconomic recovery holds, this pivot is an absolute masterstroke. They aggressively grabbed market share while every other bank was sleeping on their government bonds. But if the economy falters, if inflation spikes or rates jump again, that 28% growth becomes a massive, toxic liability bucket. The numbers look phenomenal now, but they have increased their fundamental risk profile significantly. They are now essentially A highly leveraged play on the GDP growth of Sri Lanka.
High risk, high reward.
That is the game.
If you want the Excel sheet where we calculated the adjusted cash flow and the CCR, hit the link in the description. Don't forget to smash the like button if you want us to tear down another bank's balance sheet next week.
And be sure to subscribe to Ceylon Premier Analytics for more deep dives.
Trade safe, watch the cash, not the accruals. Cheers.